What if the very indicators you're using to time the market are exactly what massive institutional whales are using to hunt your stop loss?
It's a terrifying thought, honestly.
Right. I mean, just think about that for a second. There's this built-in assumption in the retail trading world that, the more complex your screen is, the more sophisticated you are as a trader.
Oh, absolutely.
You've got overlapping moving averages, your RSI is blinking at the bottom, MAD crossing over. It basically looks like a complex geometry problem just exploded over a line graph.
It really does. And, it creates this powerful illusion of control. We tend to think that if we could just map every single mathematical variable, we can somehow predict the chaos of the market.
Yeah, like we can tame it somehow.
Exactly. Those neon-colored zigzags and oscillators, they give us a false sense of security because they provide rigid rules in an environment that is, it's fundamentally uncertain.
But then you step into the world of the methodology we're exploring today, and that massive multi-monitor control center just goes totally dark.
Pitch black.
Welcome to today's deep dive. For you listening right now, our mission today is to decode a really fascinating trading methodology from a source called Hawkeye.
It's a great source.
It really is. And the goal is to explore how the system completely flips traditional retail trading advice on its head, basically to help you avoid becoming, and this is a somewhat brutal industry term, but liquidity for market whales.
Yeah, exit liquidity. And the source material establishes this incredible visual contrast right off the bat.
Right.
It basically tells you to take that typical trader's chart, the one cluttered with all those complex overlapping indicators, and just hit delete.
Just wipe it all out.
Wipe it completely clean. What you're left with is a totally dark navy blue screen showing absolutely nothing but Japanese candlesticks.
Just the raw price.
Exactly, just the raw, unfiltered price action. They call it the naked chart.
Okay, let's unpack this because, why on earth would so many traders rely on complex indicators if, as the Hawkeye system claims, they actually just lead to late entries and consistent losses?
Right.
We're taught from day one that you need confirmation before you enter a trade.
Right, yeah, but the flaw lies in the fundamental mathematics of what an indicator actually does.
Right.
Take a standard moving average or, a relative strength index. These are not predictive tools.
They don't see the future.
Not at all. They are math equations applied to historical data. A 50-period moving average literally takes the closing price of the last 50 candles, adds them up, and divides by 50.
So it's always looking backwards.
It is literally a mathematical anchor dragging the weight of the past. By definition, they only trigger a signal after a significant move has already occurred.
Oh, wow. So relying on these indicators is basically like driving a car while only looking in the rearview mirror.
That's a great way to put it.
By the time you see the sharp turn in the reflection, you've already crashed into the guardrail. You're waiting for the price to move first so the math can calculate the average of that movement.
That is a perfect mechanical analogy. Because by the time that indicator line smooths out and finally crosses over to give a retail trader the green buy signal, the momentum of that sudden price surge has already peaked.
The move is done.
The real move is completely over. And what's fascinating here is how the market makers, the institutional banks, the massive hedge funds moving hundreds of millions of dollars, they actually rely on this exact delayed reaction.
Really?
Oh, yeah. They weaponize your rearview mirror against you.
So by the time my lagging indicator tells me to buy, I'm basically providing the exact liquidity the whale needs to safely sell off their massive position.
Exactly. Let's look at the physical mechanics of the order book to really understand why this happens.
Yeah, let's get into that.
Okay, so if a massive institution has amassed a huge position in an asset, and they're sitting on, say, millions in profit, they eventually need to sell to realize those gains, right?
So they have to cash out.
But they can't just hit a market sell button for a $500 million order.
Right, because that would crash the price.
Exactly. If they did, they'd chew through all the available buyers instantly, and the price would plummet, filling the back half of their order at terrible rock-bottom prices.
Slippage.
Right, that's called slippage. So to avoid slippage and sell a massive amount at the absolute top, they need a massive influx of buyers waiting on the other side.
So they have to manufacture demand. They need buyers who are eager or maybe desperate to buy at that absolute top price.
And guess where they find that sudden surge of eager buyers?
The retail crowd.
Bingo. The retail crowd whose lagging indicators have just flashed a delayed buy signal. The whales essentially engineer a fake-out or liquidity grab.
How do they do that?
They'll intentionally push the price up just past a key resistance level, That upward spike triggers all the retail algorithms, the breakout bots, and those lagging oscillators.
And everyone rushes in.
The retail crowd rushes in, totally driven by the fear of missing out. FOMO. And the moment that wave of retail buy orders floods the market, the whales use that incoming liquidity to seamlessly exit their own positions.
Man, that's brutal. You are buying the exact asset the whale is dumping.
Yep.
And the second the whale is done selling, all that institutional upward pressure just evaporates.
It's gone.
The price immediately plummets, leaving the retail trader holding the bag, basically staring at a screen that told them to buy just seconds before the crash.
It is a really sobering reality of market microstructure. The retail trader isn't participating in the institutional move. They are financing the institutional exit.
Wow.
This is why the Hawkeye source advocates for a massive psychological shift. It's about abandoning that reactive retail trader mindset, waiting for a mathematical equation to give you a green light based on old data.
And shifting to what?
Adopting a proactive sniper mindset, using only the naked chart. Because price action tells you what is happening right now, in this exact millisecond, without the lag.
Which brings up a critical challenge, I think, because if we strip away the indicators, delete the moving averages, kill the oscillators, looking at a naked chart just feels like staring at, red and green rectangles floating in a void.
It can be intimidating.
Yeah, without a line telling you the trend, what are we actually looking for?
Well, to the untrained eye, sure, it is just floating rectangles. But those candlesticks are a literal forensic record of capital flow.
Okay.
The Hawkeye material talks a lot about tracking real footprints in the market. Because market whales move such enormous amounts of capital, they physically cannot hide their actions on the price chart.
Right. They're too big to go unnoticed.
Exactly. The sheer volume of their orders leaves permanent tracks, primarily visible as strong momentum candles and zones of aggressive rejection.
So a strong momentum candle isn't just like a slightly larger green bar. We're talking about a scenario where the price suddenly surges in one direction, leaving a massive, solid candlestick with almost no wicks, right?
Yes.
Just showing absolute dominance by buyers or sellers.
It represents a severe immediate imbalance in the order book. When you see a candle like that, it tells you that institutional money stepped in with such force that it overwhelmed all available counter orders instantly.
That makes sense.
And similarly, an aggressive rejection zone is an area where the price approached a specific level and was violently pushed back in the opposite direction.
I get hit a brick wall.
Exactly. It doesn't happen by accident. It tells you there are massive institutional limit orders sitting at that specific price point, fiercely defending that territory.
So we're looking for where the heavyweights threw their capital around, tracking your footprints instead of waiting for an indicator to summarize it for us an hour later.
You got it.
Now that we understand the mechanics of the footprints, we need to transition into how to actually build a trap around them.
Right, the application.
Yeah, the sources apply this to major assets like gold or XAUSD or Bitcoin through this strict framework called the sniper's ambush. It's a 4-step process.
It's very methodical.
Very. And if we're going to set an ambush, the very first thing we have to do is get out of the weeds and find higher ground so we can see the entire battlefield.
Getting out of the weeds is critical because the lower time frames are essentially a war zone of algorithmic noise.
Oh,
If you're staring at a 1-minute or a 5-minute chart, you're basically watching high-frequency trading bots battling over fractions of a cent.
it's just chaos.
It's erratic, it's chaotic, and frankly, it is deliberately designed to trigger your emotions.
To make you make mistakes.
Exactly. So the Hawkeye system mandates that you filter out this noise entirely. You do this by anchoring your analysis to higher time frames, specifically the daily or the 4-hour charts, to establish the true market structure.
Because it takes a tremendous amount of actual physical capital to form and close a 4-hour candlestick compared to like a 1-minute candlestick.
A massive difference.
So the higher time frame isn't just a zoomed out view, it's a filter that isolates where the whales are deploying their billions rather than where the bots are scalping their pennies.
That's spot on. And once you have that clarity from the higher ground, you scan the naked chart to identify your kill zones.
Right, step 2.
Right. In traditional terms, these are areas of supply and demand. A supply zone acts as a resistance ceiling, and a demand zone acts as a support floor.
But we're not just looking for any floor or ceiling.
No, definitely not.
Yeah.
You're not looking for just any minor bounce or some little consolidation. The sniper is looking specifically for the origin points of those massive footprints we discussed earlier.
Mhm.
You are hunting for the exact price level where an explosive move began.
Let's dig into the mechanics of why that origin point is so magnetic. Like, if an institution wanted to buy a massive block of Bitcoin 3 weeks ago, let's say at $60,000, they likely couldn't get their entire order filled at that exact price, right?
Right, because of the slippage we talked about.
Yeah, the sheer size of their buying pressure caused the price to explode upward before all their orders were even executed.
Exactly. And that leaves a massive chunk of unfilled institutional limit orders sitting dormant at that $60,000 mark,
Just waiting.
just waiting.
Hey.
The institution still wants to deploy that remaining capital at their original favorable price. They have a vested interest in defending that level.
So they protect it.
Right. So when the price eventually wanders back down to that specific demand kill zone, it hits that wall of dormant institutional money and reacts violently.
And that origin point is exactly where you set your ambush.
That's the spot.
Here's where it gets really interesting, and honestly where I kind of want to push back on the behavioral reality of executing this.
Okay, let's hear it.
Because the theory makes perfect sense, right? Find the zone of unfilled orders, wait for the price to return, and straight alongside the whale. But let's factor in human psychology for a minute.
Always the hardest part.
It is. Say I've identified my kill zone on Bitcoin at $60,000. I'm sitting at my desk, and the price is currently at $62,000, and it's dropping fast.
Right.
It hits $61,500. Momentum is heavy. Everything in my brain, every cognitive bias I have, screams, short it, ride the momentum down into the zone, make money on the way down.
It's so tempting.
It really is. How does the system prevent a trader from trying to catch that falling knife?
It addresses that exact urge with a brutal, non-negotiable rule regarding what the methodology calls no man's land.
Oh, man's land.
Right. Step 3. No man's land is any space on the chart that exists between your identified supply and demand zones.
The middle ground.
The system explicitly states you must never engage with the price while it is traveling through this middle ground. You must wait for the price to completely reach your predetermined zone.
So even if it looks like a guaranteed continuation, even if the momentum is like a freight train heading straight for my zone, trying to capture that middle move is basically playing the market maker's game.
It is literally stepping out of your concealed sniper hideout and running wildly into an open field.
That's a great image.
The behavioral finance behind this is fascinating, really. The middle of the chart is where volatility is highest and true direction is most uncertain.
It's just noise.
Exactly. It's precisely in no man's land where market makers engineer the fakeouts and liquidity grabs we talked about. When your brain equates that rapid downward movement with a missed opportunity, your ego is taking over. Right. If you jump in early because of FOMO, you surrender your structural edge and you expose your capital to random algorithmic turbulence.
But waiting requires an almost unnatural level of cognitive discipline. I mean, if you're sitting there watching a live chart, the neurochemistry is actively working against you.
Oh, the biochemical nightmare.
Yeah, every time that 1-minute candle flashes green, you get a microdose of dopamine. Every time it flashes red, you get a hit of cortisol.
You're just a bundle of nerves.
Right. Your logical prefrontal cortex, the part of the brain that calmly mapped out the kill zone on the 4-hour chart, it gets completely hijacked by the amygdala.
The emotional center.
The emotional center that's just reacting to the flashing lights like a casino.
You are literally biochemically compromised while watching a live chart in no man's land.
Compromised, yeah.
You start second-guessing your analysis. You convince yourself the price is coming in too fast, so you should cancel the ambush.
Yeah.
Or you think, well, it's close enough to the zone, so you manually jump in early, completely ruining your risk-to-reward ratio.
You sabotage yourself.
Tinkering with the plan while the market is moving is the quickest way to dismantle your own trap.
Which brings us to step 4, the final mechanism of the Hawkeye methodology, which is how to permanently enforce this extreme patience and remove the human element entirely.
It's brilliant, really.
Yeah, because you don't rely on willpower. You rely on automation through pending orders.
Specifically, you strictly utilize limit orders paired with hard stop losses.
No market orders.
None. Instead of sitting there staring at the screen, waiting for the exact perfect moment to manually click buy or sell a market execution, you pre-program the architecture of the trade right into your broker platform.
So you build the trap in advance.
Exactly. You set a command that says, if the price touches this exact line in my kill zone, execute the trade. If it misses it by a single pip, do nothing.
You determine the precise entry, and critically, you determine exactly how much capital you are willing to lose if your thesis is invalidated way before the heat of the moment ever arrives.
You take the emotion out of it.
You set the trap, cap the downside, and then, according to the source material, you have to execute the hardest part of the entire system.
Oh, absolutely, the hardest part. You have to close the laptop and walk away.
Just walk away.
Once that limit order is placed, you must completely disconnect from the screen. If we connect this to the bigger picture, trading with a naked chart using this framework requires what the source calls deadly patience.
Deadly patience, I like that.
It's so true, though. This methodology is not designed for the adrenaline junkie who needs to feel the action of the market every single day.
It's the ultimate exercise in quality over quantity,
Yeah,
really.
it requires 3 unshakable pillars.
Mm-hmm.
First, precision to forensically identify the footprints in the zones. Second, patience to wait days or even weeks for the price to reach them.
Days or weeks, wow.
Yeah. And third, strict discipline to walk away and let the mechanics of the market execute your plan without your emotional interference.
It is a complete paradigm shift from everything retail trading culture pushes. Let's synthesize exactly what this journey requires for you listening.
Good idea.
It starts with recognizing that complex, past-focused indicators are often just mathematical traps designed to turn you into exit liquidity for institutional whales.
The rearview mirror.
Exactly. And to combat this, you transition to the naked chart, reading raw price action to track the massive, undeniable footprints of institutional capital.
The momentum candles and rejection zones.
Right. From there, you build the sniper's ambush, you filter out the erratic noise on higher time frames, pinpoint the origin of massive moves to establish your kill zones, refuse to surrender your edge in the chaotic middle ground of no man's land, and finally, you pre-program your trap with limit orders before physically removing yourself from the battlefield.
The mechanics are remarkably straightforward, but the execution fundamentally contradicts every impulsive instinct a human being possesses when money's on the line.
So what does this all mean for you as a trader? Ultimately, it means that success in this methodology relies entirely on trusting the structural setup. It demands an unyielding refusal to be drawn into the market's engineered fakeouts and, well, your own emotional roller coaster.
And this raises an important question for you to consider as we wrap up this analysis.
What's that?
Well, we began by framing this dynamic as a battle between David and Goliath, the retail trader desperately trying to avoid being hunted by the massive institutional market makers.
The whales.
But when you examine that final, non-negotiable rule, the mandate to physically walk away from the screen and surrender control after setting a limit order, it shifts the perspective entirely.
It really does.
It makes you wonder, is the sniper's ultimate battle actually against the algorithms and the market whales? Or is the true war fought entirely against their own psychological inability to simply sit still and do nothing?